Is silver the most undervalued asset on the planet? Well, if it's not, it's certainly in the running. And in today's video, I'll give you some examples of just how incredibly undervalued this critical industrial and precious metal really is. We'll see if we can glean some insights into just how much higher the silver price might go from here and the best ways to take advantage of that. So let's get to it. Did you know SD Bullion is giving away a monster box of 2024 Tree of Life silver coins? Sign up today at sdbullion.com/sweepstakes. Hey everybody, Smart Silver Stacker here. So today we are going to be talking silver, physical silver bullion, silver coins, silver bars, and even some varieties of paper silver. Now, how can silver be paper, you might ask? Well, we'll get into that because it's a critical aspect of why silver remains so incredibly undervalued. But first, I do just want to say that today's video is an update to another video that I originally published back in August of 2022. Now, that video was all about just how cheap silver was at that time when the spot price was just over $19. And today we will delve into the rather incredible fact that despite silver's spot price rising by more than 50% since that video was released a little over 2 years ago, silver remains tremendously undervalued. And in many ways, the case for silver is even stronger today than it was back then. So we will go over some updated facts and figures to back that up, and I will tell you how I am positioning myself with silver to take advantage of the current situation. So we all know that inflation is a huge issue these days, right? It seems like almost nothing ever goes down in price anymore. Everything just gets more expensive. But did you know that silver is actually cheaper today than it was 44 years ago? And I don't just mean the silver price $50 high from January of 1980, because, adjusted for inflation, that's over $200 in today's money. But at least in part, it's true that high was the result of the Hunt brothers driving the silver price up in an attempt to corner the market. So critics, well, they love to call that high an artificial price. But let's forget about that. Instead, let's take a look at the low silver price from that year, from May of 1980, when silver spot price dropped all the way down to $10.89. Now, if we adjust that price to today's dollars, even using the government's official CPI data, which almost certainly understates the real rate of inflation to a significant degree, and we are looking at a price of over $41 in today's currency. That is 30% higher than silver's current spot price. So even when we use the low prices from 4 decades ago, silver is still significantly undervalued at today's prices. Now, another metal that hit a record high back in 1980 was gold. That was without the help from any market manipulation. And at that time, gold shot up to $850 per troy ounce due to a confluence of inflation fears and geopolitical turmoil that was following the Soviet invasion of Afghanistan in December of 1979. But today, the gold price is more than 3 times its 1980 high, comfortably sitting at an all-time nominal record price. But silver? Well, silver is barely above half of its 1980 price. To match gold's performance, silver would need to rise north of $150. Instead, we're stuck at around 31. And that's why right now the gold to silver ratio, which is simply the gold price divided by the silver price, is around 85. That is a level near the high end of the historical range. But why does that matter? Well, so far in the modern fiat dollar era that kicked off in 1971 when Richard Nixon ended the convertibility of the dollar into gold at a fixed price, we have witnessed 2 major precious metals bull markets. One was in 1980 and the other in 2011. And in both instances, the gold to silver ratio collapsed at the peak of the metals markets. In 2011, the ratio dropped down to 32. If we saw a return to that ratio today with gold above $2,600 an ounce, silver's price would need to rise to a minimum of $80, an all-time record high. And in 1980, the gold to silver ratio dropped as low as 15. A return to that level would require a silver price of over $170. Of course, there's no guarantee as to how low the ratio might go the next time the metals peak, but the fact that we haven't seen the gold to silver ratio collapse at all, well, that suggests that the bull market for precious metals is far from over. Another measure of silver's relative value to keep an eye on is the Dow to silver ratio. This is a measure of how silver's price stacks up against paper assets. This is another ratio that tends to move cyclically with big drops at the peak of metals bull markets. Today, with stocks sitting at record highs and silver as cheap as it is, it would take over 1,300 ounces of silver to buy just one share of the Dow. But back in 2011, that ratio got as low as 264. And to achieve that same ratio today with stocks at their current valuation, silver's price would need to rise above $160 per troy ounce. And the 1980 comparison is significantly more extreme. At the peak of the metals market back then, you could purchase one share of the Dow for a mere 24 ounces of silver. For comparison, that would be the same as having a silver spot price today of over $1,700 per ounce. Now, look, I get it. That kind of silver price forecast, it might seem completely pie in the sky. That is until we examine some other forms of paper, specifically the U.S. national debt. Back in 1980, the U.S. debt to GDP ratio was under 35%, but today it has risen to over 120%. In nominal terms, the debt has increased by a factor of 35, rising from just $1 trillion in 1980 to over $35 trillion today and growing fast. So over this time frame, the gold price has more than tripled, the debt has increased 35-fold, and yet silver has gone down in price. See what I'm getting at here? It's numbers like these that support the claim that silver may just be the most undervalued asset on the planet right now. But even the current eye-watering levels of debts and deficits pale in comparison to what lies ahead. The U.S. federal government is on the hook for more than $200 trillion worth of unfunded liabilities. Federal pensions, Medicare, Social Security, veterans, benefits, and more. U.S. entitlements are completely out of control, and yet there seems to be no politically viable option to rein in this enormous level of guaranteed future spending. So where will the money come from? Well, it will be borrowed, of course, but from who? I mean, we're talking about more than $500,000 worth of unfunded liabilities for every American, and that's every American, not every taxpayer. If you break it down that way, the situation is a lot more grim. I mean, there's simply not enough wealth in the economy to finance what has been promised. So that's where the Federal Reserve comes in, the central bank of the United States and the buyer and lender of last resort. Now, over the past 2 decades, the Federal Reserve has expanded its balance sheet from under $1 trillion to over $7 trillion, buying up government debt and mortgage-backed securities to paper over financial crisis after financial crisis. And the out-of-control spending in Washington, with now multi-trillion-dollar annual deficits and more than $1 trillion in interest on the debt every year. I mean, this all but guarantees that at some point soon, the Fed's balance sheet will have to continue its gargantuan expansion. And what that means is massive dollar devaluation. Perhaps former Fed Chairman Alan Greenspan said it best.
We can guarantee cash benefits as far out and at whatever size you like, but we cannot guarantee their purchasing power.
And for that reason, any silver price forecast in dollar terms, whether it's $50 or $1,700, it can't be entirely ruled out because, in theory at least, there really is no absolute bottom for the value of the fiat US dollar. Now, let's talk about paper silver because this has a lot to do with why silver is so cheap. First of all, it's important to note that the silver spot price that is so often quoted, this is actually the price of a silver futures contract, a paper derivative of silver. What we have here is a system in which the price of the underlying physical silver bullion, the real tangible asset, is set by a derivative of that asset. And for every physical ounce of silver that exists, hundreds of ounces of paper silver are traded in the form of derivatives such as futures contracts and exchange traded funds like the SLV. Speculation abounds as to the nature of silver price manipulation and suppression in these paper markets, but due to the fairly opaque nature of global commodities markets, it's difficult to know exactly to what extent this does occur. What we do know is that institutions such as JP Morgan have been fined hundreds of millions of dollars for silver and gold price rigging, and their traders have actually been convicted for this. JP Morgan, by the way, also happens to be the custodian of the SLV ETF, so, well, you can draw your own conclusions here. But the thing about price suppression is that to whatever extent it does go on, it's like holding a balloon underwater. The longer you hold it down, the bigger the pop when the price finally breaks free. And when that happens, silver prices could explode. I don't know what the specific catalyst would be: massive shortages of silver, a breakdown of the futures market, a massive short squeeze in silver. But if such an event takes place, holding futures contracts or shares in an ETF is probably not going to cut it. That's why for me, my core holdings in silver will always be physical, tangible silver bullion, whether that be coins, bars, or rounds. Because paper, at the end of the day, it's just that, paper. And there are some things you can do with it, sure, but not nearly as much as what you can do with silver. Because silver isn't just a precious metal, it is also a critical industrial commodity as well. Silver is the most conductive element on the periodic table of both heat and electricity. It's incredibly reflective, it's ductile and malleable, it's corrosion resistant, and it also happens to be a non-toxic, naturally antimicrobial material. So with this host of unique properties, silver has applications ranging from healthcare to clean energy to high-tech electronics. A good example of an emerging industrial application for silver is Samsung's new solid-state EV battery that utilizes a carbon-silver composite layer to massively enhance performance. New technology like this, along with a dramatic rise in silver's utilization in photovoltaic panels, are major drivers for increased industrial consumption. In fact, the industrial consumption of silver is growing so rapidly that the silver market has been in a state of deficit for the past 4 years, to the tune of hundreds of millions of ounces. Industry is using up silver faster than it can be mined or recycled, and until prices rise significantly to incentivize increased production, this market imbalance is unlikely to be resolved. So look, don't construe any of this information in this video as financial advice, because it's not. Just because silver is massively undervalued today doesn't mean that that's necessarily going to change anytime soon. But if you are looking for a value play, an asset that is still cheap despite bubbles popping up seemingly everywhere in almost every market, then for me, it's gotta be physical silver bullion. So I am going to keep stacking while the stacking is good. Let me know what you think in the comments down below. Thanks for watching, everyone. Stay safe and happy stacking. Smart Silver Stacker, out.